Welcome to today's Canary report. Markets are finding equilibrium as investors digest the broader tech and AI sell-off that rattled indices earlier in the session. Despite a red opening for major benchmarks like the Nasdaq and S&P 500, volatility metrics have cooled off significantly, suggesting this is more of a tactical retreat than a fundamental breakdown. Let's see what our canaries are telling us about risk appetite. Speculative capital is showing selective aggression rather than blind euphoria today. While momentum leaders like IRKK and MAGs slipped alongside the broader tech complex, XBI surged nearly 2% as defensive healthcare plays rotated in from overheated semiconductor names. The divergence between XLY's 38% gain and ARKK's decline highlights that retail money isn't fleeing risk entirely. It's simply chasing value within the speculative tier rather than loading into high beta momentum traps like those highlighted by recent headlines on leveraged ETF income strategies. The credit environment remains surprisingly calm for a day when commodities are bleeding value. High yield spreads held steady, indicating that institutional investors view corporate fundamentals as insulated from the current energy and precious metal correction, even with HYG dipping slightly against the backdrop of broader market weakness. Yield curves did not steepen aggressively, suggesting liquidity conditions remain accessible, despite the headline noise around industrial jitters and geopolitical headlines. Volatility has retreated sharply, with VIX pulling back over 4% even as equities posted losses. This divergence suggests the recent selling pressure stemmed from profit-taking in megacap technology rather than a breakdown in macro confidence or liquidity. While UVXY remained flat near $27, VXX dropped slightly alongside TLT's rally, reinforcing that fear is being priced out of the system faster than stocks are pricing in downside risk for the immediate term. The real economy indicators point to resilience in the industrial and financial sectors despite the tech headline noise. Industrials climbed more than 1%, supported by infrastructure spending expectations, while regional banking stocks followed suit as deposit flows stabilize post-regulatory scrutiny. Even with SMH lagging at nearly 1% due to chip inventory concerns mentioned in recent earnings reports, IWM and RSP showed strength, implying that small-cap exposure remains attractive relative to large-cap tech valuations. Capital rotation favored traditional safe havens like long-duration treasuries and consumer staples today, while gold struggled to find support alongside the energy sector. This pattern confirms a defensive posture that prioritizes income-generating assets over speculative precious metals plays. TLT's 46% rally paired with bond funds rising suggests investors are hedging against further rate uncertainty without abandoning equity exposure entirely. The broader picture suggests a sector-specific rotation rather than a macro regime shift, with investors hedging against further tech volatility, while maintaining exposure to income-generating sectors. The sharp drop in the VIX, despite negative index returns, indicates that market participants believe the worst of the immediate sell-off may have passed, particularly as industrial and banking names hold steady against semiconductor weakness. That's your Canary report for today. Watch how semis rebound or extend losses next week. Stay vigilant, stay informed, and we'll see you tomorrow.